Good afternoon, traders. This is Christian from Hertz Tribeca Trade Group, and this is a special weekend video. I was traveling for the majority of the day on Friday. I was in the trading room for the jobs report and a little bit past the open, but I wasn't there for the whole day. But it kind of, in the beginning of the day, I think you got everything that you needed to see in terms of what was unfolding in the beginning of the day on Friday. After the jobs report that came out on Friday, which the jobs report was really not what the market was expecting. It was even though the numbers weren't huge for the jobs report, the market did not interpret it as being a very bullish or dovish report. You have to remember right now, bad news is kind of interpreted as good news, and good news, which was a little bit of a better jobs report than expected, is bad news. And the reason why is because of the environment that we're in right now. Right, the Fed is tightening. We'll go over that in just a second. There's your risk disclaimer in front of you. Everything that we're going to be going through is for information purposes only, not giving out any advice or recommendations. And everything that we're talking about is for education purposes. So we're going to talk a little bit about that. We're going to talk about what the Fed fund futures are pricing in for the next rate hike. We're going to talk about performance review for last week in terms of what the market did. We're going to talk about the indices and where they are, how they finished the week, some important levels to watch. And then I'm going to do something new, considering that I don't usually put out Saturday videos. I usually do the weekend review on Friday. We're going to talk about, how the week unfolded for us in terms of trades, how we traded the week, and a little bit of things to kind of some takeaways. And I would say the theme of the week in terms of trading is don't overstay your welcome. Just realize that right now we are in a bear market. The bounces have been, for the most part, short-lived. We've been on a couple stretches where they've been longer than that this year, but the key is don't overstay your welcome. You could have traded on both sides of the market last week, a little bit of long side, a little bit of short side, and as long as you're being very disciplined and not overstaying your welcome, you could have had some nice profitable trades. So I will go over a list of my trades from last week. I'll also go over a couple of my open positions. So that's going to be a little bit different this week. All right. So that's the old risk disclaimer. Let's get right to what I want to go over first, which is, speaking of course, that phrase that everybody knows so far in 2022, don't fight the Fed. What is the Fed? What are Fed fund futures pricing in at this point? And what changed a bit last week in Fed fund futures? Remember, this is Fed fund futures. If you're not familiar with this screen that I bring up, frequently in the trading, in the Tribeca Trade Group trading room, what I'm referring to here is what the market is currently pricing in for the next short-term rate hike. Remember, you hear a lot about interest rates and so forth. The Fed, and about raising interest rates, the Fed controls the short-term rate. Right. So this is the shortest. This is the shortest interest rate, short-term, the most short-term interest rate, because it's the overnight rate, and that's what they're controlling. So where did we start for the week? And again, this is the November 2nd next meeting that we're going to have. And you could see right now what Fed fund futures are implying is very close to 75 basis points. We started the week about 68, 69 basis points. And because of the data that we got out last week, not only the jobs report, but the ISM services number beat expectations. This number jumped from 68 to 73. So it's further implying what looks to be a 75 basis rate hike. So again, leave the the predictions to the folks that to like to make the predictions on financial media. We know exactly what the market is pricing in. You will hear also Goldman. They very much watch this, even though they don't really say. When they're saying, oh, this is how we're pricing in what we think the Fed is doing, they're looking at this because they adjusted their forecast based on what Fed fund futures are doing. This is the other one that's particularly interesting here as we look at 12/14, which is the next meeting after November 2nd. We are now also pricing in another 50 basis point hike from there. Again, it's important to know what the market is pricing in. Then if we go to the next meeting after that, it looks like it's going to be 25 basis points after that. Then it really kind of stabilizes after February. So, what this kind of tells you, and again, you could see what this graphically, you could see how this is presented to you, is that it's really looks like it's going to stabilize in terms of the Fed might be done in February. Now, this may change, and the pricing does change based on the market events. But currently, at this point in time, this is what the market is pricing in. Okay, so 75 November, then another 50 basis points in December, and then maybe another 25 basis points after that. That's what we're pricing in. That's what the market is trying to overcome, as well as, some other things that are going on here. So let's talk about the performance for the week. Let's just rehash this. As bad as Friday's price action was, and again, like I said, once we got those numbers that came out, once we go through in the trading room the exercises of what we're looking at. We're looking at what interest rates are doing, right? And that's more or less the longer end of the curve. TLT is close to the 20-year rate. ZB, this is 30-year bond futures. That's the 30-year rate. When you see these things start to go higher, you know what kind of a day you're going to have, right? When yields are going up right now, there's a very big correlation right now with what bond yields are doing and what the VIX is doing. Okay, and if we go to the VIX right now, you could see where this thing closed. Notice it didn't take out the highs, right? And bond futures didn't take out the lows either from about a week ago. So again, you kind of have this in perspective. I tweet this out a couple times a week, talking about how much the VIX seems to be following what bond futures are doing. As soon as bond futures spike up a little bit, that is, you will see, once yield starts to spike up a little bit, so does the VIX. Okay, now that relationship may change, especially if the volatility comes down in bond futures. But right now there's this very strong correlation with what the VIX is doing and what bonds are doing. So let's look at this picture, because I do want to go over this chart. Notice that we did get into the value area, and once again, bond futures were kind of giving you a sense. Once we saw this move happen in the beginning of the week, the bonds kind of stopped their rally and they started to break down again, meaning yields are going higher. Remember, there's an inverse relationship here with bond prices and with yields. So as yields take that next, started to move higher, bond prices going lower. Right. And of course, you could look at this in terms of the 10-year yield to give you a little bit better of a sense here. I just don't have value areas on the yield. But you could see that this is the yield moving up. And we did break. The important thing here was that we broke the value area. I think this was Wednesday. Once this broke, you could see that we're back in the downtrend. Right. And so we had the test of the 20-day moving average. We tested a little bit to break inside the October value area, and that basically fails. Remember, what we're using with these value areas is volume at price. Okay, and that becomes very significant when we're looking at volume at price, right? And what those levels of support and resistance mean for us. Okay, and that's the one area, of course, to make sure that you're watching. Outside of equities for me, and I think very important, as well as what the US dollar is doing. The US dollar is also stronger this week, right? After we saw, I think, 5 down days of dollar weakness, then we saw basically a pushback into the 20-day moving average, and the dollar started to rise again. The level to watch here in UUP, which is the ETF that tracks the US dollar, is 30.23. Notice we're back above all the moving averages again. We retook the 5-day moving average. The 20-day moving average was the test, and this remains in an uptrend, and 30.23 will be a level to watch in the short term to see if this can start to break back above and then start to test those new highs. Again, very important. US dollar, bonds, bond yields, they are headwinds for equities. So that said, let's go over the rest of the I don't need the risk disclaimer up again. Let's go over the rest of the performance for the week. So interesting, as bad as I started to say, as bad as the price action was on Friday, you could see that for the US indices, they actually finished in the green for the week. SPY was up 1.6%. IWM actually led, was up 2.2% for the week. Again, pretty crazy when you think about how bad we kind of finished the week. The Qs did finish in the green for the week, but they underperformed. They were only up 70 basis points. Both emerging markets and international developed markets, that's EEM and EFA, were up for the week. There you could see your bonds down 1.4%. Again, overall doesn't look that big of a move, but you have to factor that in the beginning of the move, TLT was up. GLD had a positive week, up 2.1%. We could go over that chart too, because I think that's important. There's the dollar, and there's what value and growth did for the week as well. So let's talk about the indices, and then we will talk a little bit about the sector. So let's start with gold, because gold finally got some attention, right, and is outperforming the S&P a little bit. And I do have that chart. I could bring that chart up for you guys. So let's bring up gold versus SPY, if I could find that very quickly. Here it is. That didn't take long. All right, here's what the relationship chart looks like. So gold, GLDs in the numerator, SPYs in the denominator, and you can see you've got some relative outperformance recently. All right, but like anything, relationship charts are kind of, they're interesting to look at, but the standalone charts are better. Right, and gold, I think, will be interesting to watch at the 50-day moving average. Right? I know I started to get excited about gold myself, saying, hey, maybe this is a chance for gold. And I think so many other people too are watching what gold is doing, but it's still in a downtrend. And right where it needed to turn the corner, 50-day moving average, it's stalled. Also, it got briefly above the October value area and didn't make it. So I like it when the moving averages line up with the value areas. I would watch 1713, and I would watch that 50-day moving average. But for now, you have to just understand that this is also a downtrend. And one of the definitions of a downtrend is lower highs, right, and lower lows. So here was the last, here was a low. We made a new low here. What about the highs? Here's the last time that this peaked. Gold, lower high, lower high, lower high, lower high. And then here again, we also have so far another lower high after that. So for a downtrend to be violated, that first things first is that pattern has to, the price action has to get out of that pattern. Ultimately, for me, I like to see the first thing happen is a move back above the 50, and then ultimately back above the 200-day moving average. Tough chart, because this is a very flat-looking 200-day moving average. All right, so that's gold. Let's talk about the indices really quickly. If you're a member of Tribeca Trade Group, you know that I've just been pounding the table on this level to watch, which is 37.46. There was some test here of the 20-day moving average, right? That failed. We kind of hung around there a couple days in the S&P. We did not make it through it. So you have to make adjustments. You cannot overstay your welcome, considering that the market is in a downtrend and we are in a bear market, right? Especially when we come up to that overhead resistance. That is a point to be very, very aware of, to be very cognizant of, that you could actually start to fail and break back down again. So I would say the one positive thing is here is that we had a positive week for the S&P. We did not break the lows, but we're sitting back below all the short-term moving averages and back below the value area for the month of October. For me, that is risk off and to be much more defensive in the market. If you want to look at the weekly chart too, you could see we're kind of clinging to this 200-period moving average line. We've got other things to worry about down here, but we haven't broken the lows yet. So I will begin to focus on these things down here once we break, I would say, this 200-period moving average, as well as the lows of the prior week. Also know that you've got two version point of controls. Again, why are those important? Because that's where a lot of buyers and sellers have previously met up, and we haven't returned back to those levels. That is an important area of concern. If we break those lows, then we begin to put our eyes down here for downside targets. But again, first, let's not jump to conclusions. Here's the lows. We're above them from now. But we're also in the place of, I would call it, no man's land, considering that we're below all the short-term moving averages, and we broke back below and outside of the value area for October. All right, that's as clear as I can make it, guys. Is risk off, downtrend, and being pretty defensive here. That's my take of the market. Nasdaq, I don't need to spend much time here because it's very similar to the S&P chart. Also, we failed exactly at the same place. 20-day moving average, we broke below value. We are not through those lows, the September lows, but we're very, very close to that. All right, and then finally, in terms of the indices, what I thought was kind of interesting was that the small caps were showing some relative strength, and they did outperform last week. They actually got above the 20-day moving average. So again, a little bit different picture, but they did break below that the value area. And if you don't look at Russell futures, of course, you could look at any of these in terms of the in terms of the ETF, but I would be watching 168.13. Again, a little bit better strength in small caps, which kind of got me a little bit more excited about the market for about 2 seconds last week, and then we started to see this move down as well. So this is actually a little bit different value area here because of the difference in the volume profile, because Russell futures trade almost continuously. IWM does not, but I would watch 168.13. Okay, and I think that's a must watch for next week. But regardless, below all the short-term moving averages, which is not a great sign. Okay, so again, we like to have things that we're going to watch. I keep bringing up the disclaimer. I'm not sure why I do that. In terms of sector performance, some really interesting stories that you can kind of go through here. What I find particularly interesting: what sectors did take out the lows of their September lows? Well, it's those kind of defensive areas, but when I say defensive areas, that's what people normally call them, but they're very susceptible to what interest rates are doing, right? We've gone over this concept before, but there's extra yield when you go into things like utilities, REITs, consumer staples, right? Well, you don't need those. There's less demand for those areas in equities because you could just get that yield now with what's going on in the bond market. So now, of course, we were looking at short-term rates. Let's look at all the rates right now in the US, and you can kind of see what I'm talking about here. The 2-year yield is 4.31. So forget about that's kind of explains what's going on in that XLU chart. You don't need to have extra risk right now in the equity market to get yield, right? You could get that right now and with risk-free, in terms of government bonds. Now, keep in mind, you do still have to own the bond for 2 years, but you're getting guaranteed 4.31%. And notice that the rate here is higher in the 2-year. There's no reason to go out to the 10-year, unless you really like that rate of 3.9% and think it's going to come down. But right now, you could get 4.31% in the 2-year. Again, let's bring this up for perspective. Going back to July, going back to July, it was less than 3%. So you could really get a heavy yield. So again, I keep hearing things like, "Oh, look at what Verizon is yielding. Look at what AT&T is yielding." Okay, so you can do that exercise, right? But you have to put it in perspective of what the 2-year rate is doing right now, right? So let's look at Verizon for a second, right? I can, there we go. Yes, so it's yielding 7%. So put that in perspective of what you're guaranteed with getting in the 2-year yield. That's 4.3%, right? So now you're just looking at a couple percentage points above what the risk-free is in the 2-year rate. So for me, I don't have a reason to really own Verizon. I don't like the company. I don't think that they have big, good business prospects. So for me, it's a no that I'm going to buy Verizon because it's yielding 7%. I've got no reason to go into Verizon for other than to get the yield. There's nothing appealing to me about that business model, but that may be different for you. Everybody's different. So again, I'm not giving out advice. I'm just telling you, for me, there's no way I would be touching Verizon because I see nothing really appealing about their business model. But you may love it. You may think that cable is going to continue to expand in some way. All right. So yes, so utilities. All right. I'll move on here, but look at the chart of REITs. Notice that also broke the September lows, and then consumer staples are not too far away. The consumer staples did break the low as well. Notice they did take out one of those red lines, virgin point of control. So that is one of that I thought was very interesting last week, to see those areas were the weakest of the market, right? And the best area of the market were no doubt what's been hot for all year long, which has been energy. OIH was up 17%. Interesting, because OIH is oil services. Crude did move up decently. Let's look at a crude chart very quickly, and you could see for crude, right? We did take out. So here's the crude chart. We did get out of this pattern. We took out this previous high here. We took out this virgin point of control, and we're also above the 50-day moving average. So there was some bullish developments that we saw towards the end of last week in crude, getting back up below $89. Now, note, it's still below the 200-day moving average. So it's still going to have to get through some overhead supply. But very good move right now in crude, but it's going to have another battle up here if it continues to rise. It could also come back in here and settle back in at the top of value. So something definitely to keep an eye on for next week. We could look at a couple of these things. XLE. I'll give you, my take on XLE. Watch this 83 level. Notice that it got a little bit rejected there at the top of value. It did make its way all the way through already the October value area, but now we're on to some resistance in energy in the short term. Okay, and that level to watch again is 83. I'm not going to cover all the charts here. I just wanted to go through a couple of them. Other sectors that I think were interesting last week was XME, metals and mining, but again, very difficult, and that's how this market has been all year long. Notice you got a pretty decent bounce here in XME, but let's zoom in, and you could see that we kind of also hit the 50-day moving average, which is resistance. So not really turning the corner here. Notice again, we could go through the same downtrend test, right? Here's your high, here's a lower high, here's a lower high, here's another lower high, and we kind of turned here at another lower high. So again, have to get out of that pattern. I just wanted to talk about, since AMD was in the news, AMD did break lower. That was, I thought, going to be one of the most, interesting things that would happen on Friday, whether or not, the bad news of lowering guidance, if it was priced into the stock. It was not priced into the stock. The stock fell a total of 13%. It did fail here the previous day at the bottom of value and got hit pretty hard on Friday. So again, that's going to be really the question for some of these earnings reports that are going to come out. I think that we're still going to see some more of these warnings that come out. What is going to be the effect of some of these names? How much is priced in? Clearly, in this situation, the bad news was not completely priced in to AMD. We certainly have seen a couple other examples where the bad news was priced in, right? You take an HLE, the Heli, right, that reported, went lower and then ended up going higher on the day. Micron did the same thing. Perhaps the bad news was already built into the stock price that had a significant decline, but that's not the case everywhere. And that's what's really going to make this earnings season very interesting. All right, one other chart that we might as well look at the whole group. SMH did not take out those lows from September, but very, very close to doing it. All right, so I mentioned, so that this is the rest of the performance. I'm not going to go through all these sectors, but you could see more things like the materials had a better week. Also, the banks were in there, right, that had a nice week as well. What also is breaking down? Solar, right? That actually, even though that didn't make a new low for the year, that did take out the September lows. So again, it looks like it's very vulnerable here. And it did take out these lows, but not down here yet. So I did wanted to mention that group. We certainly saw things like ENPH, which was one of the strongest stocks you know, of the last few months, break down and kind of break below this neckline. And you could consider that a head and shoulders at this point. All right. So I mentioned that I would go through, right, talking about performance for the week with the S&P up 1.6%. I had a good week. You know, and again, it's don't overstay your welcome on trades. And I think that's very important. So I'll go through a couple of, and again, all of these trades, if you're a member of Tribeca Trade Group, you know, here's the trading blotter. I will go through a couple of names that worked for me, and I'll go through the losers first. I like to talk about the losers first, because as I've talked about all year long, the nobody's going to have 100% winners. How you manage the losers is going to make or break your year. Right? You have to be very quick. You cannot stay in trades that are starting to break down. Every trade that I have, there's always a stop price on it. This way I know where to get out. This way I don't want what I refer to as the 4 types of trades. I don't want the number 4. The 4 types of trades, of course, are small winners, number 1, big winners, number 2, number 3, small losers, number 4, big losers. First 3 are fine. The 4th, we want to avoid those, right? That's how referring to make or break your year. So these are a couple trades that I have on. PayPal was one name that I ditched. You know, I got out of on Friday. As I mentioned, I didn't work the whole day on Friday. This was a trade that I put on in the middle of last week. It was the first trade that I cut. Why? Because it actually did not hit my stop price, because I just saw that the market was going to be super weak on Friday. The breadth was bad. Interest rates were higher, right? The dollar was higher. I said, you know what, let me take my most vulnerable position, which I thought was PayPal. You know, I was looking for PayPal to turn the corner. I have a whole thesis why I like PayPal. They're offering high short-term rates. I thought they might attract some balances. You could get 2.25% on cash balances at PayPal. Regardless, trade didn't work, but I'll be watching this name, see if it holds 80, 88, 86. So this was one of my losers for the week. I'm also still holding Schwab, SCHW. Now this did not break. So if you're in this trade with me, right, what I'm really watching is that top of value in the 50-day moving average. So down on this trade for the week, but it has not hit my stops, and I'm giving it a chance here. Rivian was one name that I day traded last week. I got out of this for a day trade. This was on Thursday. So this one took a small loss, this one. So it's on my list. CALX was another one that I tried. It was probably like one extra trade that I didn't need to do. I've made some money on CALX over the last couple of weeks, but I put on a trade thinking it would take out the highs. It didn't. I took off that trade. So that was in the area of a loss. Good trades for me last week. IWM, again, didn't overstay my welcome in this one. You know, I put this one on in the beginning of the week. I got the move that I was looking for. And again, we'll go up to the trade blotter so that you could see exactly what I'm referring to, right? So I think this was a trade maybe I put on, you know, I added some risk in the beginning of this. And again, you know, look at, I don't think I caught the high. That's fine, right? Entry, this was Monday afternoon, 169, and I took this thing off for, I took one target at 172, and then I also got out of this for 174, paid 169, took $5 out of it. Again, you know, that's how this trade is, right? That's how this market is right now. Take 2 targets in some trades and you're out. ALB was another one, right? Again, didn't overstay my welcome. Out at 283, paid 271. That was also one of my nice trades for the week. CEG was another one, right? $88, 86. Left the last 15%. Started to see a little bit of weakness in it, and I got out, you know, soon thereafter. RVNC, this was a trade that I started back in September. Still kind of contributed to profits. Again, not over, can I say it enough? Not overstaying your welcome. And when we're in a bear market, when we've got, you know, downtrends. Meta was a name that I played on the short side, right? Very much like measured move. I was looking for Meta. I think if we go further to the week, maybe that was Wednesday. You know, this was a day trade. You know, again, mixing in some day trades in here, target on Meta, 135. And I think I took this thing off Meta at 130, right around 135. That should be on the trade blotter somewhere in here. Here it is. Very quick trade. Okay. So, hey, those work very well too in this market. Wolf was another trade that worked pretty well. And I actually added back that trade a little bit, but again, didn't overstay my welcome in that one. Just realized, here's a target 119. I actually added to this at 116. My original cost basis was 114. Hey, that's about $5 from my original cost. Take it right now in this market. All right. AMLX also worked. That was a name that was trying to break out, but stalled a little bit. And on the secondary, but actually worked out quite nice. NBIX, I took a target in this on Friday. Unfortunately, like I said, no excuses here. But if I would have seen this took out a VPOC up here. I'm still in a portion of the trade, but the whole thing could have been taken out here right at that VPOC, right? Which are great places to take profits. Energy, DEN. I did start a position in this last week. This worked out pretty well. I did take a couple targets in this one. This one I want to try to stay in a little bit, maybe add back to 88.90. If it comes in and retests in here, because this is also a potential deal name as well. So again, still I'm going to take targets, which I did last week, giving myself plenty of flexibility, and I will add back to that one, right? Another one too, Valero, that I got involved in, just to give you a sense of a couple open positions I have. This declined pretty decently, but right into the top of value support, right into that downtrend line. For now, I'm holding it. If it starts to break a little bit further into the value area, I will ditch it. And again, I took a target in this one last week. One other one that I mentioned, again, really difficult to chase in this market. Here was your breakout of value. I actually added this on Friday morning before I left. Why? Because it came in and retested that value area, and I'll know exactly where to get out of it, which is 230. You could see I'm actually up in this trade a little bit, even though there was a down market. All right, guys. So first week of October in the green, right? Remember kind of the philosophy here. It's important to have positive months. How are you going to have a positive month? Win each week at a time, right? This is also a year, in my opinion, base hits, doubles, right? I talked about a couple trades just hitting 2 targets and getting out. Again, normally I would like to take 3-4 targets in a swing trade, but that's not the market that we're in right now on the long side. So the message there is don't be greedy with stocks and downtrends. Don't fight the Fed when you know that the Fed is there. So you got to be a little bit quicker. For me, I'm still swing trading a little bit, but I'm not staying in trades as long as I normally would. So again, 2022, all about making adjustments. Members, you will also have another video out for me tomorrow talking about some other trade setups and some names that I'm watching. Again, we'll always put together a watch list. I may not execute the whole watch list depending on the market conditions, but it always pays to be ready. If you are not a member of Tribeca Trade Group, get involved. You could go right to my Twitter page over here, and you could click on my homepage in here to get involved. If you are looking to lock in a quarter, you could reach out to me. I'll still grant that the 4th quarter special that I had a couple weeks ago, but you could go right here and you could sign up to be a member. Guys, thanks for watching. Have a great weekend. And members, you'll see a quick video from me on Sunday.